I am CA Karuna Bhansali, Secretary to CAQD, and I'm happy to welcome you all in this 15th Quality Cafe session on Saturday morning. And topic for today is audit conclusion and reporting. You all are aware that's a very, very important topic. And before we proceed, we have our convener CAQD, CA Vishal Doshi sir, who is guiding us through the proceeding of this audit cafe. So before we proceed to the session, I would like to hand over the mic to Vishal sir to begin the session. Thank you all for your presence. And let's forward to a productive and engaging session. Vishal sir, over to you.
Thank you very much, Karuna ji, and a very, very good morning to all the participants. My heartfelt thanks and a good morning to our respected past president, CA Sunil Goyal ji, our panelists, Himanshu Krishnadwala ji and Deepa Agarwal ji, and to all the participants for remaining present on this Saturday morning on a very important topic about audit conclusions and reporting. And let me share with you that when we were designing the topics, we thought that this being the month of September and the peak of the audit season, especially with respect to the non-listed entities, I would say, because for the listed entities, the sign-off has already happened. For the non-listed entities, which in terms of numbers would be almost 80-90% of the practice of each of us, we thought that this is the right time to have a session about the audit conclusion and reporting, because ultimately, whatever we do, the time, efforts, the work, the documentation, everything finally culminates or results into our audit report. And how we draft the report, the wordings that we use with respect to the emphasis, other matters, the audit modifications, all those would finally impact or would be the result of the whole audit process that we have done, and becomes pretty significant when it comes to the stakeholder. And we are extremely happy that we have very, very knowledgeable, experienced panelists in the form of Sunil Goyal ji, Himanshu bhai, and Deepa ji, who will navigate through some of the questions which are, in the day-to-day practice. Also, many times we ask that whether what is the way in which this has to be done, and also definitely on the importance and significance of our audit report, and how that has so much of weightage when it comes to the stakeholders referring to it, maybe for passing loans. So bankers would be there, employees would be there, and we have read that during our CA days about who all are the stakeholders and who rely on our audit reports. So very important session, and I am pretty confident that at the end of the session, all our participants would definitely gain. And sir, I would like to share that our confidence is that after this session, the audit reports, they would definitely be of a better quality for the March 23 year end. So once again, I thank everybody for joining in large numbers and participating in this webinar on this 9th of September. And I wish you a very, very happy learning. Thank you. And back to you, Karuna ji.
Thank you, sir. Now it's give me privilege to introduce our honorable panelists, experts who are in our panel for today's session. Our past president, Sunil Goyal, sir. He's been in CA profession for last 42 years in leading firm of India. Besides being a postgraduate in commerce and arts, he's also graduate in law and holds postgraduate diploma in taxation and postgraduate diploma in labor law. He's also member of the ICAI, ICSI, and ICWAI. He was president of the ICAI in the year 2004 and 5 and council member for more than 12 years. He has been a member of the board of director of International Federation of Accountants, SMP committees, SMP task force, and various other forum of International Federation of Accountants, New York, and apex body of the accounting profession during 2004 to 8. He has also been the president of South Indian Federation of Accountants, an official accredited body of SAR. He has also been ex-committee member of Co-Federation of Asia and Pacific Accountants, Malaysia. He has been a very learned speaker, and he has been on various other forum of International Federation of Accountants. So welcome to you, sir. With your knowledge, with your experience, we all will be benefited for the sessions. Our next panelist is CA Himanshu Krishnadwala, sir. He is co-opted member and special invitee in various committees like Accounting Standards Board, Ind AS Implementation Committee, Expert Advisory Committee, Research Committee, Corporate Law Committee, member of various groups of ICAI for Financial Review Report Board, FRRB, for review of financial statements, guidance note on Schedule 3 to Companies Act 2013. He has worked on revisions of standards on auditing, economic policy and legislative consultation group, etc. He has also delivered lectures at various seminars, conferences, presented papers and written articles for ICAI, BCA, CTC, IFAC, etc. on subject of accounting, standards, auditing, etc. He has also conducted training for CAG and corporates. So, welcome to you, Himanshu sir. And our third panelist is Deepa Agarwal. CA Deepa Agarwal has almost 22 years of experience in serving national and multinational companies in the areas of auditing and accounting, corporate law and other related matters. She has recently completed her CPA Australia, and she is working with the TD of ICAI for around 5 years and assisted ICAI in various publications such as Guide on Audit Trail, Auditing Standard Checklist, Working Paper Templates, Guidance Note on CARO, and background material, etc. She is special invitee to AASB of the ICAI and was a member of ASB and special invitee on Corporate Law and Governance Committee of the ICAI in 2019-20. She has worked extensively on the publication projects and assurance standard. So with this, I can say that we have very learned and eminent speaker in the panel, and we all will be benefited. So will require the participation from all the participants. You can share your queries, whatever queries is in your mind, you can write to us and we'll be happy to address those queries along with our questions which are there in panel discussion. So over to you, sir.
Should I take it up, Garunaji?
Yes, sir. Now I would like to request our past president, CA Sunil Goyal, sir, to give his opening remarks on audit report, a tool to enhance stakeholders' confidence.
Thank you very much. Thank you, the convener Vishal Doshi ji, the co-convener Shipriya ji, and Karuna ji for inviting me to this very, very useful topic at the current time when, particularly as Vishal ji said, that September is a very hectic month for all of us, and SMEs finalization and by the SMPs will be taking place in this month only. And often they come across many difficulties which they find that there are no ready answers are there. So thank you for arranging this useful webinar. I'm sure we will be able to solve at least some of their queries. The topic you have chosen is very apt for the present time. It's about the audit findings and audit procedures. And what we are asking is about how the audit report enhances the stakeholders' faith. It is very important. You see, audit report is actually the link between the corporate and the stakeholders. The whole performance of audit by the auditor, by way of giving assurance, is reflected basically in the audit report only. Through audit report, an auditor talks with the stakeholders, an auditor talks with the outside world, that what we have done, what he has found, and what he is reporting as a opinion point. Now, having understood that position, what has been the journey of audit report? The audit report journey, if we see across last 75 years or more, and not only in India but across the world, we will find that the journey has been very dynamic and changing from time to time, depending upon the economic nature, depending upon the stakeholders' requests, and depending upon the complexities which came into businesses, which came into standards, and which came into understanding the audit report. I remember, and I am talking about early 60s and 70s, when audit report, particularly out of India, in the abroad, Western world, was one simple para. Only one para audit report was given at that point of time, that I certify that the balance sheet and reflected is correct. Please note the word was certify and correct. These words were given at that point of time. What happened over the period of time? There was a leading case in US which made the accountants, which made the auditors liable not only to auditee but to third party also, who are not privy to the content of audit but who rely upon the audit. Now that changed the complete content of the audit report, and we shifted from certify to opinion para. So this is one example which I would like to say that how we have traveled from this para. Then, as I said, in the earlier years, it was a very short report. When I qualified my CA, we had a additional reporting called CARO. CARO was there. I think it came in 1977 originally. And the CARO reporting was there. And we used to be surprised that how our report is so bulky, including the CARO, whereas the foreign reports were very, very short, precise, and crisp. But what happened? Every aspect has both the sides. So these short reports became a problem for the Western world as well when some frauds came up, when some issues were raised by the various regulators, and when some all developments took place, that even the Western world started to realize that this report will not be significant. Not only that, the whole accounting, the whole business shifted from manual thing to automated things, computer, bigger size, mega corporation not in one country but across the globe. So all that changed the whole purpose of the auditing, and it required a meaningful dialogue between the company and the auditor. So audit report again changed to encompass those areas which were newly introduced in the business segment. I can say segment means the whole conglomerate. So then, because I again say that by audit report, we talk to all stakeholders. We talk to company, we talk to regulators, we talk to shareholders, we talk to lenders, tax persons, and that is we highlight our position there. Even till very late, if I go back around 15 years back, we were not distinguishing between that who prepared the statements and who audited it. But then came Enron. After Enron, again, there was sea change in the entire financial reporting module, because thereafter it was felt necessary to introduce, number one, the internal control of financial reporting became very, very important. After Enron, Sarbanes-Oxley Act was introduced, and Section 404 of that Act required that the management reports about the same and the auditor also report on the same. So a very complex situation which arose at that point of time was addressed by again amending the audit report. Now, as I said, the audit report now became a bulkier document. A bulkier document means it was not enough. In the earlier time, it was enough that when the auditor says that I have performed my duties and we find it blah blah blah, it is certified to be true and correct, to be correct. Thereafter, as the time progresses, the accounting standards, which were originally called the general accounting principles, and the auditing standards, which were then prevalent as standard auditing practices, they became more and more complex, more and more codified, and they took part of shape of standards, auditing standards, accounting standards. So now, what happened with after 94? There was influx of foreign companies in India, foreign capital in India, foreign joint ventures in India, and when those people came, venture fund evolved, PE funds evolved, they wanted assurance from the auditor that number one, the statements are made as per the accounting standards prevalent in the India, which we have now virtually come up to the world standard. And secondly, that the audit has been conducted by the auditing professional in India as per the auditing standards prevalent in India, which is again, we are at the world level. So in this process, what happened when we made the world level accounting and auditing standards, the regulators across the world felt that this assurance also need to be given by the auditor that number one, the accounting standards are as per the accounting is as per accounting standards, and number two, the auditing has been done as per the auditing standards. So it was felt necessary to communicate this examination of audit by the auditor through audit report. I again reiterate, by audit report, we talk to the whole world at large. So by including these paras, we were able to communicate to them that yes, the financial statements have been prepared by the management. They are prepared as per the accounting standards, and the auditor has examined them as per the auditing standards. This was the necessity thing which was incorporated in the audit report. Thereafter, evolution of audit committee. The audit committee evolved. After evolution of audit committee, there was a sea change. In the listed companies particularly, when the audit committee is there is a committee of independent persons who are not having any financial interest in the entity being audited. So a very important body came in between the auditor, the company, and the auditee. And those persons, since they were independent, that developed the confidence of the stakeholders as well as the company and the auditor. And the auditor was very conveniently and happily reported those matters to audit committee which was not considered for qualification, but which was considered suitable for disclosure. So over the period of time, disclosures increased for the balance sheet, and in the audit report also they came as the emphasis of better. So those areas which were gray areas were addressed as emphasis of better. Things further evolved, and then they came with the CAM, key audit matters. The key audit matters is a very, very useful information given to the stakeholders as well as to audit committee, that how and what decisions have been taken which were difficult for the management to be taken, which were complex, which were where two views were possible, and what views were taken and how that has been reflected in the accounts, and what decision was taken by the auditor and why. So they started being reflected as a CAM in the audit reports. So this all we can say was the journey of audit report from 40, 50, 60 to 2023. So in all arenas, as per need of the society, business world, regulators, stakeholders, the audit report changed. And I can confidently say that with every addition, with every change, with every new model of the audit report, the value of the information, the value of the discussion has been increased. So I can, for want of time, I can summarize that the audit report is a very important tool to enhance the stakeholders' confidence in the financial statement and in that. Thank you, Karuna.
Thank you, sir. And now I would request our panelist CA Himanshu Kishnadwala sir to give his opening address on expanding auditors' communication, strengthening shareholders' engagement beyond audit report.
Yeah, thank you, Karuna ji, my other panelists, Sunil ji, Deepa, and all others who are there. It's a pleasure to be here sharing my thoughts on this important topic. So for this expanding auditor communication and strengthening stakeholder engagement beyond an audit report, I have prepared a very small presentation which I will just share. So can this be seen?
Yes, sir.
Okay. So now this is something which is not maybe statutorily required, but important because the role of an auditor, it is always better that the role and what is the reporting of an auditor is informed to the shareholders, and ultimately the shareholders' engagement is strengthened, and the responsibility of an auditor is known to the shareholders. So this is a very important thing. And some of my thoughts in this topic are something like this. to just start with, if you look at any audit report, and by the way, you can see that that picture of an auditor where he depicts all his qualities, and today an auditor requires all these qualities and doing all of this simultaneously in that sense. Luckily, the auditor is also having a cup of tea by the side. Otherwise, he's sometimes too busy to even have that cup of tea. But the audit report, as I said, is a combination of clauses which are in section 143 of the Companies Act. And there are several clauses there, including CARO reporting and the reporting on internal controls on financial reporting. Then the report is also mandated by various provisions or clauses of this standards on auditing. 700, 705, 706, 710, and so on. They are issued by ICAI and notified under Companies Act. And your audit report therefore consists of a main report, which can include key audit matters, material uncertainty regarding going concern in case it is applicable, modifications to the true and fair representation, annexures for the ICOFR, annexure for CARO, and there could be additional reporting requirements by RBI, IRD, or CAG, depending on who is regulating that particular entity which is there. So if all of these things are there, the audit report can sometimes go to as high as 25 to 30 pages also. And as Sunil ji has elaborated, it has started from half a page in the early maybe 60s, and it has now reached almost 25, 30 pages of audit reporting which is there. Now, clearly with such a long size of an audit report, it is always important that the shareholders are made aware about some of the salient features of audit report, and the auditor also prepares his report so that people get interested in some of those parts rather than going through each of those 25 long pages which are there. So there are three things which are even given under statute for how do you really communicate what you want in your audit report. We have two standards on auditing, which is SA 260, communication with those charged with governance, and SA 265, communicating deficiencies in internal control to those charged with governance and management. We will elaborate on both of these in the next slides. You can also, in the audit report, refer to various notes in the financial statements or in the director's reports or in other parts of an annual report. So a shareholder can be informed about some other parts of the annual report also by references made in the audit report by the auditor in that sense. That can really improve the stakeholder engagement just beyond my audit report in that sense. And the auditor can also be a little proactive if we can address some audit report related queries at the AGM from shareholders or investor groups. And in this, you have to be very careful that you don't get into answering queries on the financial statements, but you only restrict yourself to answering queries and on the audit report drafting and the audit report inclusions which are there, which you have issued to the shareholders. So let's go with this three things one by one. So if you go to SA 260, which is communicating with those charged with governance, and this is a very important thing, and the SA 260 has said that there has to be an effective two-way communication. So it's not just communication from the auditor to those charged with governance, but also the other way around. Those charged with governance also should be communicating to the auditor as to what are they expecting from the auditor in that sense. Now, those charged with governance typically is the audit committee in the case of listed entities. If there is no audit committee in other entities, it could be the whole board of directors. And in absence of a board which is independent or something, it could be the management, CFO, or whatever is the person or a group of person identified by the auditor right at the beginning of the exercise which is carried out. And we will see later on that NFRA is very actively saying that the auditors are not doing their best in communicating with those charged with governance. And we will see that in the last slide of this presentation. So this two-way communication is to communicate auditors' independence and integrity, something very important in today's world where everything wrong which happens, the blame normally goes to the auditor. So if auditor communicates this very clearly right at the beginning, it means a lot of things to the those charged with governance. Then the auditor can ask the audit committee about relevant information of the audit. They understand the responsibilities of the management and the auditor. So the audit committee should be made aware what is the responsibility of the management and what is the responsibility of the auditor. And an example here is say identification of related parties. Now the auditor obviously cannot identify each and every related party because he doesn't know the management and who are their related parties. He will first get a list from the management. It is primarily the management's list. The auditor obviously may validate by some of his other verification processes, but the responsibilities need to be clearly divided and explained to the audit committee and vice versa. Then what is the financial reporting process by the TCWG? So how does the financial statements get prepared? What is the process that needs to be again communicated both ways. The audit committee needs to be told what is my team composition and what are their capabilities. So for instance, if some of my team members are very IT savvy, they will be told that I have a team which composes of say Ind-AS experts, which consists of IT experts and so on. The auditor may also like to explain the audit process, materiality, determination, the sample selection and so on, and whether any significant difficulties were encountered in the audit process. Now, this is something very important and laid down all in terms of this essay 260. The essay also says that you need to communicate on a timely basis and adequate communication is necessary. And it is not just a phone call or a meeting which is important. It is also important that whatever you have communicated and discussed with the audit committee, both ways, has to be adequately documented. If you go on with this, the next important thing in communication is communicating deficiencies in internal control with those charged with governance. Now, this is again going beyond my audit report in that sense, because ultimately the audit committee can answer the shareholders, can also take the management to task if all these things are known to them directly. Now, this is in conjunction with SA 260. The auditor's responsibility in this will be clearly as per SA 315 or SA 330, which is identifying risks and how do you propose to mitigate those risks. The deficiencies in internal control can be while identifying the risk of material misstatement, how are audit procedures designed based on risk assessment, and significant deficiencies in the internal controls needs to be given to the TCWG on timely basis. For instance, in this particular year, 23-24, one of the reporting which auditor is going to do on whether the company has an adequate audit trail of each and every transaction. Now, this is something which, in case the auditor has found deficiencies, it will have to inform the audit committee on a timely basis that the audit trail is not really up to the mark and there are deficiencies in the controls for it. And that will give enough time to the audit committee to ask the management to rectify this. Significant deficiencies if not resolved, and how will it impact, say, auditor reporting? Again, taking the audit trail example, if the audit committee tells the management, but the management is still not resolving the deficiency, the auditor will have to say that he may have to issue a qualification on that particular clause in this year on the audit report. The second thing where an auditor can improve his shareholder engagement or informing the shareholders is by referring in the financial statements or director's report or other parts of annual report, things about like say adjusting or not adjusting events after the balance sheet. Now there could be events after the balance sheet, all of them are not adjusting. So for instance, if it is a receivable or trade receivable which has really become bad, that will be an adjusting event. It will anyway come in the financial statements, but there could be something like a fire in the factory, significant litigation which has happened after the year end, changes in corporate structure or a change in the substratum of assets or liabilities or even environmental matters. The auditor can refer to those disclosures in any of the financial statements or director's report or maybe a management discussion and analysis or maybe even a BRSR report in that sense. And this can be in the form of referring it by way of emphasis of matter or maybe in the other matters paragraph. And this can add value to the shareholder because he knows something more beyond what is just given normally by an auditor in his audit report. And this could be just some of the significant things which an auditor can bring to the notice of shareholders. So it is not as if that the audit report is just something which you have to just follow in black and white. You can become sometimes maybe adventurous, as I would say, or imaginative, and try and include things which otherwise may not be required to be reported, but you may feel is important to inform the shareholders about these things which are there. The third thing is addressing audit report related queries at the EGM from shareholders or investor groups. Now here clearly, as I said, you cannot go in the financial statement explanations, but you can explain your audit methodology and explain what is the basis of issuing this key audit matters which are there. And the shareholders can clearly get more confidence on the auditor if you can explain this better. I understand that in mostly 99.9% of annual general meetings, the auditor is just present. He doesn't normally answer anything. But I believe it would be a good practice to ask the auditor to explain the methodology. It cannot be a back and forth thing, but he can still engage with the shareholders so that the confidence of the shareholders in the auditors can be improved. And since NFRA is the overarching body, which now looks at auditors and their work, now there are some observations by NFRA on communicating with those charged with governance. Two broad things. The NFRA has said by looking at various audit processes of various firms over the last 2 years, and they have put this in writing in their report, saying that the audit firms, when they are communicating to those charged with governance, there is improper identification of who is those charged with governance, and there is inadequate communication. In other words, NFRA has said that auditors are not very compliant on that SA 260 and SA 265, which we just discussed before 2-3 slides. And some measures which auditor can take in these cases, you can identify what is the audit committee, and that can be mentioned in the engagement letter. It is also a good practice to meet the board once a year. A call discussion with CFO, management, audit committee can be minuted. Most auditors just give a presentation in an audit committee meeting. Now, the communication can be beyond that. Maybe you engage in a one-to-one discussion. You sometimes call separate meetings other than for adopting accounts or something. Then the audit plan can be communicated in the very first meeting. And if there are any material issues, they need to be flagged off. The audit committee can be taken into confidence as to why they are including some things as key audit matters. And the auditor can also have separate meetings with independent directors. Now, this will help them to actually engage better with the shareholders, and it is really going beyond your audit report in that sense. So, I think the auditor today feels that, yes, he is above all. That is not so. He is part of the whole system, and the better he can communicate to the shareholder, in addition to what is given in the audit report, the better would be the position of the auditor, which would be understood by the shareholder and the other stakeholders. So I think that is something which can be done by the today's audit firms and auditors in that sense. So I think with this, I would just like to end and hand it back to Karunaji.
Yeah. Thank you, sir. Thank you very much. Now I would request Deepa Agarwal to present her opening remarks on communicating complexities in reporting.
Thank you, Karuna. And thank you to the entire CAQ for this opportunity. And thank you to Vishal Doshi sir, Shri Priya ma'am, and my panelist, Sunil Goyal ji and Himanshu Krishnadwala, for setting the tone and for explaining so comprehensively. I myself was listening that the way you were explaining the evolution of the audit report over the number of years, starting from 60-70, when probably it was just a one para. And when we are talking about the report running into number of pages, which Himanshu ji explained that this is like something which has been evolved significantly. Karuna, can you just play it on the full screen mode? Yeah. So I'm really thankful for all of you for this opportunity to be with you today. And as both of my panelists mentioned in their remarks, that the audit report has evolved over a period of time, and there is an increased expectation from the audit report, from the auditor. So it's not just the, I would say, not just the audit report or the the literature or the various standards, I think the way auditor is applying, the way the professional judgment is being exercised also plays a very important role. I would like to divide my discussion in the form of opening remarks in two parts. One is on the role of auditor and second is on the audit report. There are many interesting ongoing developments affecting the auditing profession, and I think most of us would agree in light of the regulatory environment. Himanshuji mentioned about the NAFRA, the super regulator, you can say, and the global financial crisis. We keep on reading a lot of news articles every day, what is happening across the globe. There is even more of a role for the auditors to play in helping restore the confidence of analysts, investors, stakeholders, and others in the financial reporting, and increasing the relevance of the financial statement audit. So in a nutshell, auditor has a very, very important role to play. If I just talk about the regulatory environment in the country, since the introduction of the Companies Act 2013, auditing has evolved with the ever-increasing change in the regulation. So be it amendment to the Companies Act, Himanshuji mentioned about the audit trail. And if you remember the amendment which happened last year in August for the books of account, that the backup has to be maintained on a daily basis on a server located in India. Remember the Schedule 3 requirements wherein the companies are required to make comprehensive disclosure, and thereby the auditor also has to report on CARO talking about the regulatory disclosures and the requirements in the audit report. So whether it's accounting, whether it's introduction of NDS and the amendments made over a number of years, I think the requirements are getting enhanced. So resulting from corporate failures, expectation of auditors has increased manifold with the stakeholders and shareholders, lenders, investors, and regulators are expecting more. They're expecting more, kind of action from the auditors to be more challenging and more forthright in reporting. At the same time, the increasing complexity of business and financial reporting has also increased the volume of financial statement disclosure, like revised Schedule 3 and other information. So other information, if you remember, we have a paragraph in auditor's report, which is a separate paragraph other than from the basis of opinion, the basis of the qualification, if there is any, wherein the auditor has to talk about whether there is any information which has come to the notice of the auditor's report, which is not part of the financial statement and which is not in line with the financial statement and the information obtained during the course of the audit. So I think there is something one need to understand the audit report clearly. And if I just talk about communication, I think my panelist speaker have spoken a lot about the better and more communication. And definitely, if the timely communication is there with the audit committees, with those charged with governance, I think this is something which is going to improve the entire system. So what happens when we audit, when you as an auditor play the role, you meet the board of directors, promoters, have a discussion. A lot of it stays inside the organization in discussion with the audit committees that range across a whole raft of key issues, such as your internal control, risk management, and IT system. But if you look at your ultimate deliverable, which goes outside to the public, is your audit report. So in a way, auditors are the on-the-ground eyes and ears acting on behalf of the investors, and they understand the areas of the financial statement that pose a greater risk for the misstatement. So let me just take you through the current audit report. Karuna, can we move to the next slide? Yeah. I just want to present this one slide, which you can see on the screen. It explains the current structure of the audit report, which is applicable for the periods beginning April 2021. And there are amendments which keeps on happening. For example, if you remember, last year they made applicable Rule 11E and F, which is on the intermediary ultimate beneficiary and the funding requirement and the payment of dividend. So if I talk about the existing requirement, we have a full-fledged SA700 report, which is very much in line with the international standard issued by IASB. Additionally, we have a separate section on other legal and regulatory requirement, which talks about books of account. So for example, I mentioned that last year there was an amendment made by the MCA in the company's accounts rule, whereby the company has to maintain the backup of the books of account on a server on a daily basis, and which has to be accessible at all times in India. In terms of the new requirement, Rule 11E and F was introduced, which I mentioned, funding transaction and complies with dividend norm. And audit trail is applicable from the current year. So any audit report which is going to be signed from the next year, which means March 2024, the auditor will have to mention specifically whether the audit trail has been maintained throughout the year. I think you can refer to the ICAI implementation guide. There's a it captures a whole set of implementation issues and the illustrative reporting examples. And then if I talk about the auditing standard, there is a very comprehensive, the implementation guide or the reporting standard 700, 705, 706, which gives you plenty of guidance in the form of FAQs. And then you have implementation guide on SA 701, which covers the key audit matters. So I heard when Sunilji was explaining Sunilji was explaining about the key audit matters. I think key audit matters is something very, very important for the listed companies, and you can refer to the example and figure out, what is the right key audit matter to be communicated to the in the audit report. In terms of ICFR, we have a very extensive report in ICFR, and this makes the audit report running into a number of pages, including CAQD 2020. So CAQD 2020, if you look at comprehensive revision was made in 2020, and the number of clauses and subclauses put together makes it 250, and which has 10 specific disclosures being added because of amendment in Schedule 3. So if you look at the structure of the audit report, this has been very, very comprehensive, and the report is something running into a number of pages. Now, what I would give you as my personal piece of advice, sitting in the month of September, you need to figure out what are the issues to be discussed with the company, so to avoid any last minute surprises. So if you believe there were any issues in reporting in CAQD last year, let's say in your report signed in March 2022, you should see that whether the information has been provided to you in time. If not, then you need to speak to the management upfront. If there was any modification in the previous year's audit report, let's say there was an issue in the inventory verification or the inventory valuation, you need to address it, that whether they have given you sufficient evidence or whether the qualification is still not resolved. So I think what you have to look is to figure out what were the issues in the previous year and what are the issues which you expect in the current year. If you're the first time auditor, you've accepted the audit recently, you should also look at the previous year auditor's report and think about, what could be the possible issues. So that is something which I just want to advise before you issue the audit report. The formats are very much there. You can go to the ICAI website. You can go to the SA 700, 705 and 706 format, looking at how to draft the qualification. And I would also like to add that, the CAQ has done a fantastic job of issuing these publications. The two very important publications, one is on the significant audit matter and second is a comprehensive compilation of the qualifications. I think both publications are very, very relevant. They're based on the audit reports for March 2022. I think that last year, everyone was trying to create their own database or figure out which examples to look. So now at least you have one place issued by the ICAI where you can see that what kind of qualification, if you can search on the subject, you can look at the CAQD modification and take help in terms of the drafting. I think that is something very important I would like to highlight. In terms of the other information, I would say when I talk about the complexity in reporting, I think other information is one para probably which users may not understand, and therefore there is a need for providing more clarity. We do not provide any assurance on the other information. We just say that any information which has been given as part of the annual report, for example, the companies are providing the BRSR reporting, providing disclosure about climate-related risk or the commitments made for the climate change. Any such kind of information, the auditor is required to read and state whether there is any material inconsistency. However, there is no assurance being given on such other information, and therefore it is very important that such statement should be explicitly mentioned in the audit report. Now, let me talk about some very, very important points when we talk about communication in the auditor's report. And when I say communication, specifically, I want to discuss 2 points. One is on the qualification, and second is on the emphasis of matter paragraph. So when I talk about the qualification, an auditor is required to obtain sufficient appropriate audit evidence to provide a reasonable assurance so that they can issue a true and fair view of the state of affairs. Now, definitely, it's not an absolute assurance, but it's a true and fair view. And if you look at the auditor's responsibility paragraph, which talks about detection of material misstatement, understanding of internal control, disclosures made by the management, going concern assessment. However, when it comes to qualification, it is very, very important to remember that the auditor needs to make a quantification of the qualification. If you look at 705, it clearly says that the auditor is required to make a quantification of the qualification unless and until it is impracticable. Now, what is impracticable is not defined in the auditing standard, but I'm sure you would have read in the accounting standard and some other literature that applying every reasonable effort to do so. If you're not able to quantify because of any other limitation, it's not quantifiable, then you have to explain it very clearly in the basis for modification or basis for qualified opinion paragraph. So quantification is something very important, and along with the qualification, what you also need to remember, the management note is very, very important, which means the note which has to be given by the management explaining the facts, explaining the view taken by the management should also be very detailed and comprehensive. And if the reader or the user is reading the qualification with the management note in the financial statement, I think the qualification, the matter should be absolutely clear to the reader. So therefore, many times what happens, auditor do spend time in even reviewing the note or looking at the note that whether the qualification can be very precise or crisp if the note is very detailed. So that is something very important when you draft the qualification for you this season, that the note should also be read through. And the second point I want to highlight is on the emphasis of matter paragraph. Emphasis of matter paragraph should not be used as a substitute for a qualification. Many times you can pick up the report, you will see that the auditor is including any area where they believe it's not clear, evidence is not available as the emphasis of matter paragraph. Emphasis of matter paragraph fundamentally means that there is a matter which you need to highlight in the auditor's report, wherein you are not agreeing with the where you are agreeing with the manager. So I think EUM is something very, very important. Apologies, slightly under the weather. So what you need to remember is the emphasis of matter paragraph should not be given many times and should be used in a very, very limited situation. For example, 706 talks about 706 talks about that you can only use emphasis of matter paragraph, for example, if there is an accounting treatment which is approved by the quota scheme and that is in variation with the accounting pronouncement or the accounting standard. So that is something which you need to keep in mind, that EUM should not be used as a substitute for a qualification. And we as professionals should remember that the underlying objective of an independent audit is to add credibility to the financial statement. So when we are drafting the audit report, we should remember this, we should keep this in mind, that whatever reporting we are mentioning, whether it's a qualification, whether it's other information paragraph, this is something should be very clear. The access to the capital market, merger, acquisition, and investment in an entity depend not only on the information that the preparers are giving or the management is providing in the financial statement, but also on the assurance that such financial statements are free of material misstatement. While an audit does not by itself guarantee accuracy of the financial statement, it provides users with a reasonable assurance that the entity's financial statement give a true and fair view in conformity with the accounting pronouncements within the applicable financial reporting framework. And before I end my closing remark, I just want to highlight that as Himanshu ji mentioned about the report, the inspections, the role being played by NAFRA, I think the role of auditor is under continuous scrutiny. And I remember reading that article wherein, it has been mentioned that the auditors should not take shelter of being only a watchdog and not a bloodhound. The expectation from the auditors are increasing day by day, and the role of the auditor is becoming onerous. And one of the key challenges which we are facing as an audit profession is finding a way to communicate more about our work without breaching any client confidentiality. So I think this is something at best we can do in terms of our audit report. And with this, I'll hand over back to Karuna. Thanks, Karuna. You're on mute. Sorry. Karuna, you're mute. You'll have to repeat.
Yeah. Thank you so much. Thanks a lot. So with this, we are moving towards our panel discussion. And my first question is to our past president, Honorable Past President Sunil sir. Sir, SA 700 refers to the fair presentation framework and compliance framework. Okay, so please explain these, and is there a choice of framework that can be allowed, that can be followed?
It's a good question. In fact, if you go carefully, the requirement of SA 700, it prescribes and it defines both of same. What it says is a fair presentation framework is used to refer a financial reporting framework that requires compliance with the requirement of framework. So that is common. Compliance with the requirement is common in both the frameworks, but it goes further. It says that acknowledges explicitly or implicitly that to achieve fair presentation of the financial statements, it may be necessary for the management to provide disclosures beyond those specifically required by the framework, or acknowledge explicitly or implicitly that it may be necessary for the management to depart from a requirement of the framework to achieve fair presentation of the financial statements, although it is expected to be very rare in actual occurrence. So now basically this is what we have been traditionally discussing about the rule-based versus principle-based concept in the auditing. Matured jurisdictions have always gone with the have not supported the rule-based, but the principle-based auditing they have supported always. So these two types of frameworks are not necessarily different only, but they encompass each other. So when we call about the fair presentation framework, it overarches the compliance framework and gives some leeways here and there to add something or to deviate in a rare circumstances, which is duly explained and which, like what just Deepaji said, when you concur with the management, but you highlight the same as the EOM. So that is a one leeway given, but as the standard says, it should be used very, very rarely. When you consider something because of many development events, you find that it is necessary. Otherwise, if you go with that, these are to be taken together. And in my opinion, the fair presentation framework will cover that also, and that is the framework which is being followed in India. Even if you see Section 133 and 129 of the Companies Act in India, it very clearly says that the company shall prepare its financial statements in accordance with the accounting standards prescribed in 133, that is compliance framework, and shall give a true and fair view. Now, this addition to the true and fair view is in furtherance to the compliance framework. So, therefore, while complying with the accounting standards of Section 120, as mentioned in 133, the presentation in the form of a fair presentation framework is also envisaged by the company. And I am of this view that the report should be given accordingly. Thank you.
Yeah. Thank you, sir. So, sir has very nicely explained compliance framework and presentation framework. And we are receiving many questions from our participants also. But after taking our panel discussion question, we'll be taking all the audience questions.
That
so
is
my
better.
question is to Himanshu sir, that sir, does 700 apply for audit report on financial statements prepared in accordance with the special purpose framework as well?
As Sunil ji has said, there is a fair presentation framework and a compliance to which SA 700 applies. However, there are other frameworks also to which SA 700 would still apply. And if you see the SA 800, and SA 800 is really reporting on other frameworks, and SA 800 clearly says in various paragraphs that if you are forming an opinion and reporting on a special purpose financial statements, the same framework shall apply, SA 700 revised, which was there. And even if you do it on a single financial statement or a significant element of a financial statement or any special purpose financial statements, the requirements of SA 700 shall also need to be considered as per SA 800, which is there. So I think whatever framework you report, SA 800 also says SA 700, and SA 700 anyway therefore becomes the overarching standard where you will have to apply the reporting principles which are there. And SA 800 covers all this in paragraphs, all 11 to 14, which is there for the reporting formats.
So for Deepa, I'm taking one audience question for you. Our audience is asking, EOM is also looked at as if it is a qualification by auditors. If EOM is something that auditor is agreeing with management, then why to highlight something which is already disclosed in notes to accounts?
Thanks. A very interesting and a relevant question. I think, first of all, one should understand that we should not be kind of using EUM very widely. So I agree that it should not be used as a way to provide a qualification. Second, there is a very, you'll have to figure out the cases or understand the situation where EUM may be given. If the matter is adequately disclosed in the financial statement, I totally agree with the person who has raised this question that there is no need to highlight in the EUM. However, there could be situation. For example, there is a very important transaction which has happened during the year. Or let's say the example which I took about the accounting treatment approved by the court, which is in deviation with the accounting treatment prescribed in the relevant gap. Now, that is one example which is already given in one of the implementation guide. So EUM should not be used, very for every situation or matter which has to be highlighted, but only wherein the auditor believes in his or her professional judgment that it is important for the user to see it or to highlight in the auditor's report. Another common example which I can give is the COVID-19 situation. If you remember, almost all the audit reports were carrying that paragraph that because of the uncertainty in COVID, there could be a impact on the financials, on the assets, on the recoverables, on the debtors. So, these situation could be there, but I totally agree with the person who have raised this question. We should not be using EUM very, in all the situation where the disclosure has been made in the financial statements. Thanks, Karuna.
I think I'm receiving many audience questions. So, first, I'm taking my question and then we'll take one by one audience question. Right? So, sir, my question is for past president, sir, Sunil, sir. How does the auditor comply with this essay if the law regulations prescribe a format of the auditor's report that is different from the format required under SA 700? So please provide a real-world example of how auditor can balance compliance with both legal format and auditing standard in such cases.
This question comes very often. It has been coming with every development in the laws, with every changes which every regulator has required. So it's very often when the auditor is faced with this dilemma. However, since very beginning, when the accounting standards and the auditing standards were not either codified or they were not partake of the company law, there has been a constant decision taken by the council that if there is some regulatory requirement which requires the auditor to do something or not to do something, then it will supersede the requirement of the auditing standard. Even the same applies to auditing standard as well. So whenever a law, a regulation, or a statutory requirement requires the auditor to go beyond SA 700, then it will be imperative on the auditor to do this thing. With the complexity of many industries, like we take insurance industry, we take banking industry, we take telecom industry, we find that the regulators have included several type of assurances to be given in the audit report. Even in the MDA, new MDA has come, although it is in the company law itself, but all these changes are coming up, and therefore sometimes as per law it becomes necessary for the auditors to comment upon the same, which is in compliance of the law, and it is not treated as a non-compliance of SA 700. What is required basically, if we read these both these properties, that as far as possible, the contents given in the SA 700 should be reiterated in the audit report. So whatever paras are there, we can say, without being in conflict with the law, they should be provided in the same manner in which the statutory law requires the report to be given. And any additional item, then naturally it can be provided. If there is a anomaly, then naturally the law prevails. Examples are very many, and the most common example is the tax audit report. In tax audit report, you comment upon 3CD, whereas the 3CD is not a normal part of our SA 700. So similarly, wherever this law casts extra duty on the auditor, the same need to be compliant. Thank you.
So I'm taking our audience question. Sir, this question is, Himanshu sir, this question is for you. So our audience is asking, can you please explain the line of difference between CAM or EOM paragraph? Example, non-moving stock for more than 3 years.
Yeah, so this is again a question which is very commonly asked and discussed with our clients in a lot of situations. So a key audit matter is something which has started only maybe since the last 4 or 5 years, and a key audit matter is not something which is which is just informing the shareholders and maybe the readers that there is a particular item in the whole audit which I have done, which I would like to tell you this was critical in the entire audit process, and I would like to tell you what was that audit item and how I followed that particular audit process for it. So say for instance, if you're doing a bank, you will say that the IT systems, the information technology systems is a very crucial part of the bank. I have considered that in my audit process, and how did I verify the IT system and how did I place reliance on it? Now the example given here, non-moving stock for 3 years, that says something where the auditor needs to gather evidence as to whether it has a saleable price. And if it does not have a saleable price, it should have been provided for or it should have been written off. It can neither be a CAM nor a UM in that sense. It's an audit process. And if the auditor believes that it has no value and should have been written off and the client is not doing so, it will actually become a modification in the form of a qualified report rather than a UM or a CAM. So, I mean, a modified report, EOM and a CAM are 3 totally different things and none can replace each other in that sense.
Thank you, sir. So moving to next our question, Deepa. Deepa, how should an auditor frame his opinion where a statute or court order or government directive permissions allows an entity to prepare financial statements without meeting a gap requirement?
Thanks, Taruna. I think this is a very common question which comes in case of a scheme of merger, demerger, amalgamation, or other arrangement which are approved as part of the quota scheme. We have guidance in our implementation guide capturing this specific question. So while I believe that this should have been reduced now, considering there's a specific requirement in the Companies Act and the SEBI regulations, which requires that any such a scheme should be accompanied by the auditor certificate certifying the correctness of the accounting treatment proposed in the scheme. However, even if we have a situation where, let's say, the court or the central government has approved a accounting treatment which is in deviation with the accounting treatment prescribed in the accounting standard, whether it's Ind AS or the accounting standard, then what is the responsibility of the auditor? The auditor's responsibility is that it will not be considered as a qualification. However, it will be considered as a modified framework, which means the accounting treatment approved by the court or any other regulator will be considered as a modified framework compliance. And if the effect is material, then the auditor needs to describe the resultant deviation from the framework in sufficient detail in an emphasis of matter paragraph. And wherever there is an emphasis of matter paragraph, I want to highlight the management detail note is a must. So which means the management note should be very much detailed, explaining such deviation, explaining the quota scheme, and explaining the accounting treatment. Yeah.
My next question, sir, Sunil sir, past president sir. Sir, I will ask you 2 questions. One is participants' question and one is my panel question. So first I'm asking you this audience question, that company issued bonus share. Does this require any reporting in audit report or CARO?
I don't think so. As far as I recall, there is no separate reporting required on the issue of bonus shares. And if you see the whole scheme, while the company is reporting EPS, the EPS will itself reflect the impact of the bonus shares on the issued by the company. So in my view, it is not required to be separately reported, although the calculation of reserves, etc., will automatically correspondingly affected by issue of bonus shares.
And my question is, Sir, it's coming into my mind that an auditor is signing the audit report at a place other than the city where the entity's registered office is situated. So, do the director or auditor need to sign the financial statement at the same location? Or further, does the auditor report need to be necessarily signed on the same date as the date of the board meeting in which the financial statements are approved?
Again, a very good question, and this was a very gray area till some time back. And when I remember when I was studying or when I was in the early years of my chartered accountancy, this was the understanding and this was the practice that everybody is required to physically present at the same location at the same time when the accounts and the audit report are being signed. However, with the evolvement of auditing standards and with particularly the guidance given the technical guide, it is now made amply clear that it is not necessary for an auditor to be present at the same place where the board meeting is being held, or where accounts have been approved, or it can be signed from the distant place. Moreover, after COVID, when in the COVID times, the dispensation was given by the MCA about many things, about even the board meetings, AGMs can be held from online. And what I perceive is that this important development is going to continue. It is now abundantly clear that auditor is not required to be in same place. And what I'm seeing nowadays, they are not even the same country where the board meeting is being held, and they are signing the report from the distant places. Because you see, the digital signatures has done wonder in this regard, because it need not be signed physically. Anywhere he can append the signature on any document. As far as the dating is concerned, we all understand the importance of dating. The importance of dating audit report contemplates many things. It contemplates that he has seen the balance sheet of a particular date which was approved by and adopted by the board on a subsequent date. The dating of audit report will also have a role in determining the cutoff date by the auditor, where the event after balance sheet date will be affected by his cutoff date when he chooses to sign the audit report. Speaking technically, naturally, the signing cannot be before the date when the accounts are approved and adopted by the board. It can be after that date. Practically speaking, if it is a date which is different from the same date, then the board will be required to meet again and adopt that accounts as per the company law again. So I think that will be a problem for the board and an unnecessary duplication of the work. So what we see is normally the same date reports are being signed. Legally, there is no bar on audit report being on a date after the adoption of the board report by the bank.
So signing cannot be before the date. And my next question to Himanshu sir. Sir, nowadays we see scope limitation is can be observed at lot many cases. So if you can brief with the examples of scope limitation and how does it impact audit opinion?
Yeah, so scope limitation is a serious affair in an audit process, and it clearly means that if you have asked for 100 things and out of 100 you have not got few of those things in the audit process, and if that is something very significant and material to your making an audit opinion, it can be a scope limitation which is there. And a scope limitation is something which you can discuss with those charged with governance, and if still the information is not supplied, you can consider how you can deal with it in the audit report. In fact, the standard which is there, again SA 705 is which is there, they have said and gone to an extreme to say that if the scope limitation is very serious and can impact your entire audit opinion, you can withdraw from the audit. And that is the extreme level at which SA 705 has gone, that you can even withdraw from audit if the scope limitation is very serious in that sense. And basically, you have to look at from two angles. Whether the scope limitation is something which is likely to have a material misstatement on financial statements. In such a case, if it is material but not pervasive, it can be a qualified opinion. If it is material and pervasive, it would be an adverse opinion. And if you are not getting the sufficient and appropriate evidence, it can again either be a qualified opinion or a disclaimer of opinion which is there. A disclaimer means that I have done the audit, but I am not able to decide whether it is giving you a true and fair view in that sense. And there are several examples of a scope limitation which is there. The simple things which everyone is understanding on a scope limitation is, say there is a fire in the factory and the records are destroyed and not available, or if there is a strike in the factory and records not available, or search and seizure and the records are not available. These are very simple things in that sense. However, a major scope limitation arises, say for instance, when the management says that we will not undertake a confirmation process. So you say that I need a confirmation process of my bank accounts, receivables, payables, and so on. And the management says I will not undertake a confirmation process, because without the support of the management, you yourself cannot do a confirmation process. Similarly, there are some payroll senior employees in your organization where the company may say that we will not share their employment details or what are the terms of employment because they are confidential. There are sometimes some things where there are business agreements which the management says are very confidential and will not be shared with the auditors. Now, these three examples are serious examples of scope limitation, and the auditor may really consider in that sense whether he wants to give a disclaimer, a qualified opinion, or an adverse opinion in that sense. But the auditor in no case can say that because things were confidential, management did not show it to me and therefore I have not verified those particular items. That would be a deficiency in the conduct of the audit. How to deal with a scope limitation, that depends on how material is the information and how is it likely to materially impact your financial statements. Yeah, fine.
Yes, sir. So my next question to Deepa. First, I'm taking one audience question. Then we'll be moving towards our panel question. While reporting on consolidated financial statements, if components are not audited or reviewed one, and only management prepared accounts of components are consolidated, then how far it is appropriate? One more part is there in this query, that in CARO 2020, while reporting on lease property, in case the agreement has expired and not renewed, but possession of property continues with lessee, then there appears to be some anomaly in how to report in such cases. An example is like BPT leases of office building in case of CARO 2020. At times, certain factual comments are made by auditor but may not be adverse. So for consolidated annual report, such comments are also to be reported.
Okay. Thanks, Karuna. I think this question can be broken into three parts, but I'll try and answer one by one. So I think first question is very common and very relevant, that how do we deal with the situation where we are the group auditor and some of the components are not audited, or by the time we are issuing the audit report, they would not have completed the audit. For example, if you're a listed company and you have a private company, because they may have a different timeline. So the answer or the guidance which is given, even in the guidance note on consolidated financial statement issued by the ICAI, one has to look at the materiality. So when I talk about materiality, if the component is material to the group, and materiality, the thresholds are not defined anywhere, but yeah, as a firm, as an auditor, you can decide that. So if the component is material to the group, and if the financial statements are not audited, and if these are only management account, then you would have to consider the impact in the audit report. And when I say impact, it could be a modification, qualification, because you would have a kind of you would not be able to ascertain the impact on the group financial statement. So if the component is material, let's say if I give you a percentage, let's say it's more than 5%. In many cases, many firms follow 5%, many firms follow 2%. You may have a higher threshold also. So basis you believe that you do not have the audited accounts, you would have to call it out as a qualification in your audit report. However, if you believe that the component is not material and substantially you have performed the work as a group auditor, and some of the firms also may carry some of the additional procedures, then probably you may not require to include a qualification. So that is one on the components which are unaudited. You can also look at the illustrative wording given in the guidance note on CFS on the consolidated audit report. The second question on CARO 2020, I think leasing CARO is one topic on which you can have a separate session in my view. But yeah, I think the leasing property if the agreement has been expired and not renewed, and then probably even if in that situation, one has to call out and include it as a factual matter in the reporting. And related to this question is that I think this is the biggest challenge. How do you deal with the clause 21 or the last clause in the auditor's report in CARO 2020, which talks about the inclusion of the clauses reported by the competent auditor, which are in a qualificatory nature or may have an adverse impact. So what the guidance note says is that you will have to understand this from the competent auditor. So which means if I'm the group auditor and you are the competent auditor, Karuna, I'll ask from you which are the clauses which you believe may have a qualificatory in nature, and I would report that in my report. So I may ask few questions from you, but the guidance note is very clear. It is something which I'm not going to apply any materiality threshold here. So I think factual comment is not required to be included if I talk about the intent of that clause. However, if there is any non-compliance, if there is anything which you believe could be a matter of a qualification or an adverse remark, then it needs to be included in the CARO report. Thanks, Karan.
One question I'm taking from my question actually, that is how do auditors address potential misinterpretation or misunderstanding of their finding in their reporting process?
Thanks. This is again a very, very interesting question. So as I think every one of us and especially our past presidents have mentioned about the audit report, and then Himanshu added that it has become very complex. And you have your ICAI opinion, your CARO, your regulatory matters. So this has become a really, really comprehensive report. So one should also understand how do we actually report so that it's easily readable and understandable from the perspective of the users. So what is potential misinterpretation or misunderstanding in the reporting process? This is something very important to understand. So therefore, while you have 700 and you have any qualification which you're including. So as I explained, one needs to be very careful when you are drafting a qualification. So qualification should be clearly drafted in a very crisp and fine language along with a management note. And it should not be used as an EUM. So one is something misunderstanding can cause if you are not drafting the qualification clearly, or if you are drafting a EUM in the nature of a qualification. So let's say you're drafting a EUM saying that attention is drawn to para so and so of the financial statement where the note has been given. However, we are unable to determine the impact of the qualification, impact of the matter on the financial statement. Now, if you use the word like this, we are unable to determine the impact of the matter on the financial statement. One cannot call it out as an impressive matter paragraph. So that could create an misunderstanding, misinterpretation of the communication made by the auditor in the UM. And in the qualification, I think, as I mentioned earlier in my notes, in my opening remarks, it's very important that the note has to be very detailed. If you have a discussion with the management at the right point of time before including the qualification, that this is a matter which can be included or which is being included as a qualification, and they can explain the perspective in their financial statement. I think this is very important. And the other thing which I want to highlight, I already mentioned, I think the two publications which have been issued, I think all of you should refer to those publications and start drafting your qualification in that manner. So this is something I just want to add.
Thank you, Deepa.
I will add, I will add to what Deepa just said. You see, it is a fact that the financial statements and the audit reports have become unwieldy. And there is often so much inflow of information required either by good governance or by the CAQD report, as we start about the good governance in India. Our own SEBI LODR regulations are there. So the seeking out of the information after this whole lot of 100 pages or so, maybe more even, is very, very difficult. Even as chartered accountants, when we try to read a report, we are supposed to know where the crux lies, but it becomes very, very difficult. So very fine line has to be drawn between providing adequate information, but not too much information. I've seen some qualification in some report where the prelude to qualification runs in 2 pages. And that's too long a preamble to be laid down to for the qualification. So it should be very crisp, very precise, but yes, should be given the full facts. These two maybe appear to be contradictory, but not much difficult. I remember every 20 years there is a cry. There is a lot of hue and cry, which they come with the cut the clutter. The campaign goes like cut the clutter, clutter at the top, clutter in the reporting, clutter in the financial requirements, clutter in the. So maybe sooner than later we will have again a rerun of this system, because I fully agree with Deepaji that this has become very, very long reportings are there. And in the maze of that, a common man loses the sight of the relevant facts. Because I do wonder that someday we will be asked to give an executive summary of the audit report. Like we give for the internal audit report, somebody may ask us to give the statutory audit report also. So that needs to be looked into by the regulators. Thank you.
So one more, sir, Sunil sir, like I'm asking you question from audience. Like due to work from home era, clients do not have proper evidences for some key transactions. Should they be disclosed in audit report even if not material?
Sorry, please come again. Could not hear you.
Due to work from home, clients do not have proper evidences for some key transaction. Should they be disclosed in audit report even if not material?
No. First of all, in every audit decision, the auditor has to ascertain the materiality. And disclosing about non-being evidence not being there about any document in the audit report is not an excuse to avoid a qualification or to give a modified report or a disclaimer report. So first of all, not availability of document and evidence is a part of audit procedure. Then he need to understand and he need to then carry out the alternate audit procedures. If he is not able to obtain the primary evidence, that by any alternate audit procedure, can he ascertain that the accounts are not impaired from the fair presentation? So it is not at all relevant whether he discloses them in the audit report, he discloses give a EOM or CAM, will not absolve him of the responsibility. So if it is relevant, he has to go accordingly and may be required to be qualified. And if it is not material, then he has to take a holistic call. And then by use of supporting other measures, he can either say that it is he is convinced about the same, or he has to give a qualification.
One question from my collection of the question. Can you share some practical example of situations where seemingly immaterial misstatement had a significant impact on the overall audit conclusion?
Oh yeah, there have been many times we have seen this thing happening, and one glaring example is a contingent liability. Under the head of contingent liability, in a small line, this way small para, like there is often a clause about the pending litigation. Then in the garb of pending litigation, what is said to be pending litigation, there is a evidence available with the company that the case is almost lost and the liability is not immediate, but it has already been arisen. At that information, in a seemingly very innocuous misstatement given by the company, can have tremendous effect. And we take the effects can be significant. Like if you take the question of cancellation of 2G telecom licenses, cancellations of coal blocks, huge liability coming. Now NGT is there, National Green Tribunal is there. Suppose Green Tribunal levies a heavy fine on a polluting company, then the whole going concern may be impaired. So these, in one example, I come to my mind is the contingent liability. Secondly, is that balance confirmation. Now, balance confirmation was not very particularly adhered to. Even today, I am not very satisfied about the compliances by the company as well as the auditors. But after a particular fraud in IT industry, everybody woken up and the balance confirmation took some pace. Again, it has slowed down. I'm very discomforted at that. But giving a line by the management that balance confirmation we have sent, but they are not responding. And the auditor also says that the pending balance confirmation, I'm giving this note, huge frauds can be concealed by that manner. And even if not frauds, many inaccuracies can corrected by the system. Reconciliation, we have seen that sundries and sundries ad was there in the banks till 15 years back, and in the garb of sundries, many huge amounts were lying there as unreconciled, which ultimately had to be written off by the management. So that is one area where we can find the seemingly very innocent statement. And now in the NDS, the ECL, the expected credit loss, is again will be area where the management and the company has to be very, very cautious in reporting properly, and any small looking misstatement can have a bigger results. I think that will be some examples of that.
For Himanshu sir, again I'm having two questions. One is from mine and one is from audience. So first I'm taking audience question. Generally, the audit report, in order to comply with SEBI Regulation 33, are dated the 60 days of year end. So when the director's report and annual report would not be ready, then what is the import of other information in audit report, because it cannot be verified as an audit report?
Right. So this is something directly the application of SA 720, consideration of other information in the issuance of audit report. Now, there are a lot of inconsistencies sometimes in what the auditor writes and what is there sometimes later on, which comes in a director's report. More than a director's report, it may come in that management discussion and analysis report. So say, for instance, a company is in the manufacture of, say, motor cars. Now, the motor cars are manufactured using some current pollution norm which is there, and the audit report is issued and everything. However, the director's report or the management discussions and analysis later on says that after 3 months or maybe after 6 months, the pollution norms in the motor car industry has undergone a change, which will require a very heavy investment by the company, and maybe it may have to close operations for some period for that. Now, this is an inconsistency because the audit report doesn't carry this fact at all, or the financial statement don't carry this fact, but this is there in the other information in the financial statements. Now, SA 720 clearly says that if that other information is not available within those 60 days when you sign the report, you write that in your audit report, that whenever you receive the other information, you have a right to modify your audit report. If the information is already available to you, you consider that information when you are issuing the audit report. So I think the auditor in such cases will have to look at other information whenever it comes. And in case it is inconsistent from the information which he has included while certifying the audit report, then he can issue a modified report if there is an inconsistency in the same. SA 720 clearly provides for this. Unfortunately, however, most of the auditors don't look at that other information later on when it comes. And there are cases where we have seen that, at least in one case, we have seen that because of SA 720, the audit report needed to be revised, mainly because of some environmental issues which the company faced later on.
And sir, one important question from my question bank, that is, how can auditors strike a balance between following established audit procedures and exercising professional judgment in reaching conclusions?
Now, this is something where you are asking the entire audit process as to how audit happens in that sense. So when you follow audit procedures, you start with something called as audit planning. In the audit planning, you look at audit evidence, and you start therefore with something like SA 700, which says how do you conduct the audit in accordance, SA 200, how do you conduct the audit in accordance with the standards of auditing. So this is establishing your planning and the other processes which you will set up. Then you have got audit evidence, which is SA 500, which is there, which is the crux of the entire audit process. How do you do evidence? How do you do sampling? It is supported by other standards like SA 315, 330 on assessing risks and other things. And some of these things which come out in this is professional skepticism. And professional skepticism, which is listed down in SA 200, which would also be there in SA 500, is something where an auditor cannot accept everything at face value. So you have to strike a balance between, do you trust the people Obviously, we trust all the people in the management. However, I do not trust them to the extent that I accept everything at face value. So I will ask, show me some evidence to support what you are telling me. And this applies when I am talking to the auditee accounts department, the CFO, or even the top management which is there. And this is something you have to tell the audit company, that we are going to question you. That does not mean that we are suspicious about you have done something wrong. It is part of my audit process to question you. And I have to document when I question you and what you are telling me. Now, that is professional skepticism. I think in the recent past, some international body had done a study on professional skepticism as to how auditors exercise professional skepticism in various countries. And it was found out that in India, the audit firms and the auditors do not exercise professional skepticism better. Other countries do that, but in India, we tend to trust our clients much more than what is done in other countries, which is there. So I believe that if professional skepticism is followed by Indian auditors, no, the audit quality will improve in that sense. And if you have your audit procedures as per SA 200, audit evidence gathered properly along with professional skepticism, at the end is taking a professional judgment, which is what you are asking, that how do procedures help your professional judgment which is there. Now, a professional judgment can be a wrong judgment, but it's still a professional judgment, because on hindsight, you can say that, oh, I took a judgment before 2 years when I did the audit, but today I believe that I could have something different. But if you have taken a professional judgment using the audit process you have followed, uses the audit evidence you have got, and also justify that you have done a professional skepticism properly, then a professional judgment while issuing a report, say giving a EOM rather than a modification, will still not hold you in wrong thing. No one can still say you have done something wrong, because you have followed the due process of getting into the professional judgment exercise.
My next question is to Deepa, one audience question and one from my question. So how far management is responsible for audit?
Okay, very good question. So I think management is very much responsible for the preparation of the financial statement on which we are issuing an audit report. The audit report remains our responsibility and is our ultimate deliverable. I think we have spoken at length about the audit report. So while there's a specific paragraph being included by the auditor in the audit report as per SA 700 under the heading management responsibility for the financial statement. So it is very, very important, one, when we write these assertions in the auditor's report, that the management is responsible for the preparation of the financial statement in the manner in which that responsibility has been explained in the engagement letter signed between the company and the auditor. So the description clearly described that the management is responsible for the preparation of the financial statement as per the applicable GAAP, as per the framework. So one, the company is responsible for preparation of the financial statement in accordance with the GAAP. Second, to make sure that it is free from material misstatement, and for which even the management gives a written representation to the company, to the auditor. The management also has a responsibility for the design, implementation, and maintenance of internal control. So while we call out everything in these lines in the auditor's report remains the responsibility of the auditor. However, what is important is that when the auditor is including any paragraph in the auditor's report, whether it's going concern, whether it's a modification, there has to be a perspective from the management. There has to be a discussion with the management. So if the auditor is commenting on the going concern, that he does not see any issue on the going concern, because there is a paragraph on the going concern as well, it is very important that the management should have made that assessment of the going concern, that there is no issue with the management's assessment of the going concern. So I think if you look at in wholesome in totality, I think this is very important that both have to be, even the user, the lenders, the stakeholders, and even the regulator will read the audit report and the financial statement together. So therefore, one has to be the audit report has to be based on the financial statement, and the audit report should clearly refer at relevant places, whether it's an emphasis of matter paragraph, whether it's a key audit matter paragraph, whether it's a qualification, to the relevant note in the financial statement. I think, and one last point I want to add here is one should remember that at the time of any investigation, inquiry, inspection, proceeding, by whatever name you call, what is being looked at by the regulator is the audit report. What have you reported in the audit report? I think most of you would have seen the number of notices being received, whether it's part of your FRRB inspection, your QRB inspection, or anything, that the auditor has reported this, auditor has not modified this, auditor has not done this, the company has not given a disclosure in accordance with Schedule 3, and the auditor has not made a suitable modification in the auditor's report. So I think this is something what I would like to add. Himanshu ji, you would like to add anything here?
No, I think that's good enough. And because ultimately audit reports is the face of whatever you have done. In fact, we tell our teams in the office that even if you do an audit for 3 months, please make sure whatever you do in those 3 months get captured in the report. Whether you want to EOM, whether you want to include in CAM, whether it goes to TCWG and so on, because that is ultimately what the readers look at you from perspective.
So, one more question. What strategy can auditor use to effectively communicate with their clients about audit conclusions without undermining the independence and objectivity of the audit process? How do you strike a balance between transparency and confidentiality when reporting sensitive audit information?
So I think I would like to add here that the confidentiality, we have a specific requirement in the Code of Ethics. The auditor is governed by the ICAI Code of Ethics, the professional regulations. So the auditor is very much required to maintain client confidentiality. And unless and until there's a requirement in law to make a specific disclosure wherein the auditor may make such disclosure. So what is, I would say, the important point to remember as an auditor is that we should remain objective, impartial, and unbiased. So we need to remember that the people trust our work. So when the regulator or when anyone is asking, so for example, if you're just submitting a tender, many times the ask is get it certified from your statutory auditor. If you're asking for any scheme, we talk about PLI scheme or any such a scheme, they ask you to get a certificate from your statutory auditor, so which means it carries a high level of trust. So if the report, if the certificate is carrying your signature, it means that you are being trusted as an advisor, as an auditor, so that it is, your work is being trusted, and therefore our primary responsibility is to provide a fair opinion on the financial statement and other regulatory reporting requirement. So clients respect this attitude and expect no surprises. So my suggestion is that there should be adequate planning. So if you spend enough time, for example, you're everything well planned. Many times people say 40-50% time is spent in planning, then your execution is very simple. So plan well in advance and communicate early to ensure the client has adequate time to absorb any surprises or news which they perceive as negative from the auditor. Also maintaining the two-way communication. I remember that slide which Himanshu presented in the beginning. It's very, very relevant. So maintaining the two-way communication with the management, whatever name you call it, the board of directors, those charged with governance, audit committee having oversight on the board of directors. You need to remember that it is very important to maintain a continuous communication with them. It is not sufficient that the issues are highlighted only at the end of the year when you're about to issue the audit report. So if there is any important issue which is being there, please highlight it to the management, engage with them through the one-to-one discussions, see if you have the quarterly audit committees, meet with them, and you have that fair conversation. And if you just, I would also like to bring in one point here is on the recent NAFRA circular. I think all of you would have read it. So it talks about that, all the frauds have to be reported to the central government if it meets the threshold, even if it's identified by the management. This is one requirement, which is again bringing the focus that you have to have a continuous dialogue with the management. How will you get to know if there is a fraud, if there is a suspected fraud, unless and until you have that continuous communication with the management or the audit committee? So that is something very important. Yeah, that's all.
So now one audience question, and then we'll move to this concluding part. So Sunil sir, this question is for you. Can a company keep its BO at its holding company's registered office and not at the subsidiary or originally registered office?
Yeah, I think the company law itself permits this, and I think the relevant section will be 128. which says that it is permissible provided this kept in India only and not out of India, and the complete address is informed to ROC, and the proper intimation in the prescribed format is given to ROC in time by the board.
Now, one question which is common and as a concluding remarks for this session for all the panelists: how do audit firm incorporate lessons learned from previous audit engagements into their conclusions and reporting process, and what steps can audit firm take to foster a culture of continuous improvement in the conclusion drawing and reporting process?
Karunaji, sorry, there was some technical error in my side. Can you please repeat the question?
Yeah, actually, it's how do audit firm incorporate lessons learned from previous audit engagement into their conclusion and reporting processes, and what steps can audit firm take to foster a culture of continuous improvement in conclusion drawing and reporting process? And also, if you want to give some message to our participants, audience.
Okay.
Yeah.
So may I?
Yes, Sunilji.
Yes, sir.
Sure. So thank you. This is a very overarching question and very, very important. See, where I remember when I was attending meetings of IFAC as a director. So when we have a fundamental principle in our CA course that we have made a commitment to lifelong learnings. So when you do CA, when you practice a CA, the commitment is there that we will be learning with every audit, every incident, any event, but it may occur. And naturally, every audit, every matters which comes to us teaches us something. So what we learn in the process of our discussions, developments, and what we see in the environment means the economic environment, what comes as recent circulars, recent guides, recent decisions of council, of court. No, they all modify, tend, or refine our understanding. And if we have learned something, if we have faced some difficulty in some audit, and later on we learn something, we must apply that, and it should be reflected. Like I will just give an example that the CAT tools, the auditing through computers. Now, lot of tools are available, and even our institute has done a remarkable job in making available to all, even SMPs also, through their practice members committee. The wonderful support is there. So if we were not able to do this thing earlier, the time is very, very ripe and urgent that we should use all those facilities, learn the outcome. And when we started applying some tools, we were really amazed how fast the results were obtained, which we were doing a long drawn process was there earlier. Even the Excel worksheet use, a number of us are not doing properly. The Excel is a wonderful program, and any SME company can very well be audited by using the Excel program and Excel queries properly. All abnormal transactions, all transactions which require a deep investigation can be identified and examined if the proper use of Excel is made. I find that the corporates are going more and more on ERPs. And when I say ERP, it also partly includes Tele. Now, Tele is used by more than 70-80% of the businesses. Alternate programs come, and nowadays Joho books. Joho is coming as a very, very strong contender, and it is really a versatile program where we are seeing. But so one should be acquainted very well with that Tele, whether it is the Wings, whether it is that Zoho. So whatever programs are coming in that, it should be very well acquainted with that. Learning from previous audits is one area which we all always keep in mind, because suppose we did an audit and we face some difficulty. I will give an example. Actuaries report. Now, after the AS15, which requires the actuary report in larger corporations have become very, 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 very significant part of even the provisioning, because there might be heavy provisioning required on the same. Earlier, the actuary report was considered by the auditors as a sacrosanct. So whatever is said by the actuary was taken as such. However, when this actuary report became subject to scrutiny because of AS15, the institute and the auditors went deep into this and found that while the actuarial part of the report is left to actuary, but the financial aspect of the report must be scrutinized properly. And I'm talking particularly about the financial information, the assumptions which the actuary takes, and most importantly, the discount rate which is applied by the actuary to arrive at the actual liability of AS15, or it is even in the insurance company. So that may be that now we are examining with more closer scrutiny than what we were doing earlier. I think I will summarize it here, that every succeeding audit we apply, we write, we understand that whatever we have learned till that date. Thank you, Karuna.
Himanshu sir, the same question is for you and for your concluding remarks.
Okay. So I think having done an audit, when you do the audit again, there are obviously bound to be some improvements which are done. However, that doesn't absolve you from any so-called mistakes if you have made in the first year, because the audit in the first year is nothing like a recce that, okay, I'm doing a recce in the first year and I will improve everything in the second year or something. Every year is an audit where your quality has to be really maintained. And however, the only few things which you can benefit in the second year and onwards is maybe some of the audit procedures which are there can be made more efficient. In the first year, maybe if you have done a confirmation process by selecting a particular sample and based on the response you have got on that confirmation process, in the second year, you can make that process more efficient in that sense. Okay, it is better I could have done it like this. I will save some time in the whole process which is there. Again, when I have deployed teams in the first year's audit, I may find that some teams are not to the best of their ability able to handle audit of a particular sector or industry. I may change my teams in the second year again to make it more efficient in that sense. Thirdly, my timelines can be improved and the deployment of teams within the timelines can be made more efficient. So if in the first year I have taken maybe 3 weeks to do a review or audit, in the second year, my focus should be to reduce it to say 2 weeks or 2.5 weeks, because that is how your efficiency builds in and your maybe or even the profitability builds in the second year onwards or something. So I think the whole focus, at least when we do an audit in our office in the second, third, fourth year and all, the whole focus is to build efficiencies. Whether my teams can become more efficient, whether my interaction with the client can be more focused, and whether my timelines can be truncated to issue reports on a much faster basis than in the first year in that sense. And to that extent, we always tell a client, make sure that you have your FCP, as we call it, financial closure process, which is clearly mapped out to what you do, and our teams will be aligned to your financial closure process, which is there in that sense. So I think in one word, if I have to summarize subsequent years, it is efficiency. We have to strive for efficiency in the audit process from the second, third year and so on. On some last words on audit, and this is what I speak and or tell in a lot of programs which I address, that if you are in doubt that whether you need to modify your report or you don't need to modify a report, please go and modify the report. The benefit of doubt normally should not go to the client, because if something goes wrong later on, the client will just be penalized, but you may lose your COP in that sense. So for you, it is your bread and butter audit report, whereas for a client, it is just some penalty which could be levied. So in that sense, what I tell a lot of firms, especially in the other towns or villages or places where I go and address, is that do not really do any favors to a client in that sense by not reporting what is not to be or what is otherwise to be reported. And a very simple example is reporting in Caro on a maintenance of a fixed asset register. If you ask most of the audit firm, they say that is a standard thing. How can I tell in my report that the client does not have a fixed asset register. He knows he does not have a register, but he is shy of reporting that the client does not have a fixed asset register. If tomorrow the peer review board or NFRA hauls up the audit firm, the client will say that I do not have it. It was told to the auditor. Why did he not report it? So I think you have to be very clear that what is there, what is not there, and your responsibility is more towards the standards on auditing. A client is there today and may not be there tomorrow. What is important is your efficiency and your quality, which is finally relevant in the whole process. So thank you, Karuna, and thank you all for this patient listening to all these answers, our views.
Now I hand over the mic to Deepa.
Thank you. Thanks, Karuna. And I think both Sunil ji and Himanshu ji have explained very in elaborate manner how should the audit firm incorporate lessons learned from the previous audit engagement. I would like to add a few points based on my experience. I think I would suggest that you should think about developing and strengthening the guidance or the templates or the enablers for your audit engagement team. While ICAI has also issued your audit working templates, you have these standards and auditing checklist. I think make them part of your working papers, your files. You should look at, as Himanshu ji mentioned, look at learnings from the previous audit engagement and see where were the gaps. So you keep on improving on those audit work programs and your papers. Also based on the inspection. So every firm has to undergo some inspection or the other, for example, peer review, FRRB or the QRB. So one should look at the learnings from the inspection also and where are the improvement areas, whether any trainings are required within the firm. The regulatory reports are also there in public domain. You can even look at the regulatory reports and reporting. Audit report guidance is also, can be revised for the next year's reporting. An audit firm may come up with a bulletin board or an alert on the best practices, improvement areas, and key learnings and findings, and that can become part of your overall policies. And you can always look at the reports issued by the other firm and do a benchmarking. Like I always prefer to look at what the other firms are doing and see if there are any improvement areas. Are you missing out on something which is very important? Also, if you are the continuing auditors, it definitely serves as an added advantage since as an auditor, you are aware about the previous year issues, findings, reporting matters. And if there's a modification, then you will have to immediately see whether that has been resolved. And one should not forget that there's a reporting obligation in your 710, the standard on comparative, that if it's resolved in the current year, not resolved in the current year, if it's a continuing impact for the current year as well as the previous year, then both the years has to be modified. So I think that is what I just want to talk on the incorporating lessons from the previous audit engagement. And to as far as my closing remarks are concerned, I think I would just like to say that the regulatory environment is quite stringent. I think the auditor's role is under a lot of scrutiny, and we keep on reading. Anything happens, the question comes: where was the auditor? Where is the auditor? And who is the auditor of this company? So I think the auditor needs to be very diligent. As Himanshu mentioned, we should not shy away from reporting the qualification. And if there is any doubt, we should not take it on ourselves by thinking that we are doing a favor for the client. I think when it comes to reporting, we need to be very, very straight and clear. And it is important to also document all the communication. So wherever you face any issue wherein any matter has come to your attention and you are thinking that whether to report or not report, I think the first step you should be doing, having a communication with the management, should send it in writing and should ask for the responses and accordingly evaluate the reporting application. IC is already doing a lot. I think there's a revised code of ethics which is also coming up. So please make yourself aware about all the pronouncements which keep on coming up. IC has recently issued 7 exposure drafts. So there are so many new standards and regulations which keep on coming up, and the expectations are getting higher and higher, be it stakeholders, be it regulators. So I think there's a lot of things which we need to do as the audit, I would say, besides we have to keep our professionally updated. So and wish you good luck for the upcoming season for the audit, and thanks for your patient listening. Thanks for asking all the relevant questions, and I'm sure there are many questions which have not been answered, and definitely, Karuna, we can take them offline. Thank you.
We are having our Deputy Convener CAQD, Shri Priya ma'am, with us. So now I would like to hand over the mic to her for her remarks.
Thank you so much. And at the outset, so we've been doing a series of webinars on Statutory Audits 2023. And I've personally been very passionate about it. I mean, I may not know everything, but I'm trying to do one every day for 2 hours. So we're trying to cover as many, short 100 people participant sessions. So it was one for Coimbatore today. So thank you very much to our veterans, Himanshu ji, Sunil Goyal ji, a big namaskar, and Deepa for having joined us today. I think I'm sure most of it is covered, and I'm certainly going to look at the video recording on this and use a lot of what was said here in my other sessions. But I think what's very interesting and a huge change is the way auditing is perceived as a profession today, and how there has been a drastic transformation in reporting itself. Schedule 3, which was essentially supposed to be financial reporting, has acquired a very strong management reporting context, in terms of aging or your disclosures in terms of strike-off companies. But all of these do have a significant impact on finally the true and fair itself. The second thing is, I think there is also a lot of change from audit being all about solvency, which is going concern, etc., to which obviously we need to pay a lot more attention. We somehow tend to assume going concern as an assumption rather than test it very seriously in reporting the conclusion. I think one significant change I saw after ILFS particularly was this entire audit transformation from being targeted towards solvency to going to be targeted towards liquidity as well. Our requirement to comment on short-term ratios, etc. I think this is a big change. The third thing is also in terms of a perception. However, we stand on the top of the roof and say, look, fraud is beyond a statutory auditor. I think there is an overarching kind of pressure on the profession to rise up to this fraud challenge. Now, how we will do it, I don't really, we may not have all the answers, but I must also hasten to add that in terms to locate, and a case in point is Coffee Day. How could we have missed something so large? And I think, so it's somewhere we're sitting on the wall, but I think it should be our endeavor at least to ensure that there are no material frauds. And I think that's more driven by a common sense approach than anything else. And finally, when in doubt, I don't think we are required to stick our necks out. And you're expected to be independent of the management, and I think you should stand for what the profession demands. And my own theory on this is, when in doubt, disclose. Might be the simplest thing to do. I don't think we should get hyper technical to say it is not required as per this or as per that. And all of us seek to serve a national cause. And another last kind of insight I want to share is, the Companies Act gives you tremendous protection as an auditor. It gives you a 5-year uninterrupted tenure. This is like going to a doctor. You go to a doctor and you say, okay, my stomach is aching. You can't tell the doctor, you give me this tablet and perform this procedure on me. It's the doctor's prerogative. Very similarly, I think once you're appointed as independent auditor, and that's what your report reads, independent auditor's report, you're expected to be independent. And today, if somebody wants to remove you as an auditor, he has to get permission from the central government, a right that I think we ought to exercise. But at the same time, if you feel you can't be independent, it's nice not to accept the engagement, because otherwise then you get into this moral dilemma. And I think today it's a very big non-audit market also. It's not necessary that all of us have to do audit. I think if we rise up to this challenge, I think we'll make for a great profession. And to be very honest, I think we do a great job. And I'm not saying this because I'm part of ICAI. I think we deliver exemplarily good quality in the audits that we do. Unfortunately, if it's an errant politician or an errant MD, it is that person. But if it's an errant auditor, they say, oh, all auditors, which is very unfair. And the last insight is on fees. I think good fees drives good quality, and good quality drives good fees. And you can do your research as well, but I think we are most, Sunil ji will also, I'm sure, agree, I think we must be the lowest charged, audit charged economy in the world, whether you're comparing a Mitsubishi and a Maruti or XYZ Limited and another foreign company of equal size. I think that's something that we need to do a lot about, and I think it's for ICAI and more particularly the branches to emphasize the fact that we need to charge good fees. So with these words, thank you very, very much to Himanshu ji, to Sunil Goyal ji most importantly, and Deepa Agarwal. Very nice to see diversity, and let's rock. So
Thank you.
Thank you.
Thank you.
Thank you very much.
Thank you very much.
Thanks to
Thank
all.
you, ma'am. So now, formal vote of thanks as we come to the close of this Quality Cafe session on audit conclusions and reporting. It is both an honor and a privilege to extend our heartfelt gratitude to our three esteemed panelists who have contributed their time, expertise, and insights to make this session a resounding success. Today, we have been privileged to hear from three distinguished professionals who have not only illuminated in complexity of audit conclusions and reporting, but have also inspired us with their knowledge and experience. And each panelist has brought a unique perspective to the table, enriching our understanding of this critical aspects of auditing. First and foremost, I would like to express our sincere thanks to our Honorable Past President Sunil Goyal sir. Your in-depth knowledge and ability to articulate the intricacies of audit conclusions have left an indelible mark on all of us. Your insights have undoubtedly broadened our horizon and will serve as a guiding light in our future endeavors. Next, we extend our heartfelt gratitude to Himanshu sir that your expertise in the art of crafting effective audit reports has been nothing short of remarkable. Your practical tips and best practices will undoubtedly shape the way we communicate audit findings in the future, promoting clarity and transparency. Lastly, but certainly not least, we offer our sincere thanks to Deepa. Your insight into the challenges faced in the audit process and the strategy to overcome them have been invaluable. Your candid sharing of experiences has been a source of inspiration for all of us as we navigate the complexities of auditing. Today, our panelists have not only shared their knowledge, but have also ignited a passion for excellence in the field of auditing. Your willingness to share your wisdom, answer questions, and engage in meaningful discussion has been truly commendable. I would also like to convey my special thanks to Vishal Sir, Convener CAQD, and CA Shri Priya Ma'am, Deputy Convener CAQD, for their vision and guidance for this Quality Cafe session. I would also like to convey my thanks to my CAQD team and technical support. In addition, I would like to extend our gratitude to all the participants for their active engagement, thoughtful questions, and valuable contribution. It is our enthusiasm and commitment to learning that make event like so rewarding. In conclusion, I want to emphasize that our journey does not end here. The insights gained from today's session will continue to guide us as we strive for excellence in audit conclusions and reporting. Thank you. Thank you so much. Thank you to all of you. Thanks a lot.
And that was the best ever vote of thanks we've ever heard in a long time now. Thanks, Karuna. Thank you.
Thank you. Thank you very much.
Thank you, ma'am. Thank you, sir.
Thank you. Bye.
Yeah.